Hey there. Welcome back to another video. In the last one, we talked about how a trading plan consists of three main parts: strategy, money management, and psychology. To be a successful trader, it breaks down to 10% strategy, 30% money management, and a whopping 60% psychology. So, let's kick things off by diving into how to build a solid strategy, and then we'll work our way to the most crucial part, psychology. Stick around, it's going to be enlightening. The term strategy originates from the Greek word strategos, referring to military commanders who led small groups of soldiers in ancient Greece. These commanders were responsible for formulating plans and tactics to effectively confront and counter the schemes of adversaries. Thus, strategy inherently involves having a predetermined plan aimed at neutralizing threats and achieving specific objectives. This historical context highlights the importance of strategic thinking not only in military applications but also in various fields such as business, politics, and personal development, where careful planning and foresight are essential for success. Trading is a lot like being on a battlefield, right? You're the commander, and your trades are like soldiers following your orders to secure that victory. The market and its moves are the enemy, constantly shifting and trying to throw you off your game. And at the end of a trading session, your account balance is basically the scorecard that tells you how well you fought. Just like in war, strategy and quick thinking are crucial if you want to come out on top. If you've noticed, I've used the term trading period. The win or loss of a trade is really just like surviving or losing a soldier on the battlefield. I mean, which war doesn't have its casualties, right? For a commander, the outcome of the battle is what matters most, but ideally with minimal losses. No commander goes into a fight thinking it'll be completely without casualties. It's all part of the game, both in trading and in war. So, if you've decided to dive into the world of trading and entered the battlefield, you gotta understand that some of your trades, or soldiers, are definitely going to get lost along the way. Trading isn't like a math class where 2 + 2 always equals 4, it's more like navigating through a foggy maze. Even with all the technical or fundamental analysis you do, there are just too many unpredictables out there. You've got to be ready for the rough patches because, trust me, losing some trades is just part of the game. The market can flip-flop at any moment, and it doesn't always play by the rules of our analysis. So, you might wonder, why bother with a strategic approach to trading? Well, the answer is pretty clear. Having clear-cut rules in a trading strategy helps us choose entry points in the market based on a consistent, predetermined method, which can boost our chances of winning. It's like having a game plan in a sports match. Without it, you're just reacting to the game instead of playing to your strength. When we develop a trading strategy, we establish clear parameters for our stop-loss levels and determine when to exit a trade. A well-defined trading strategy prevents our emotions from taking control over our decisions, ensuring that we make rational choices based on established criteria. This disciplined approach is crucial for maintaining a consistent trading performance and increasing the likelihood of profitability over time. By adhering to a strategic plan, traders can better manage risks, respond effectively to market fluctuations, and ultimately enhance their chances of achieving favorable outcomes in their trading endeavors. George Soros, a prominent trader in financial markets, achieved remarkable success on September 16, 1992, by shorting the British pound, resulting in over $1 billion in net profit. This bold move not only solidified his reputation but also made him a key figure in finance. In an interview with the Wall Street Journal, Soros attributed his success to a straightforward approach. Before entering any trade, he meticulously answers 3 clear and precise questions. This disciplined methodology emphasizes the importance of careful analysis and strategic planning in high-stakes trading scenarios. Soros' experience serves as a valuable lesson for investors regarding the significance of thorough preparation and critical thinking. George Soros says he always asks himself 3 important questions before making a trade. First, he figures out where and based on what criteria he should enter the trade. Next, he decides where he'll take his profits if the trade goes well. Finally, he determines the point at which he'll exit to cut his losses if things don't go as planned. This clearly shows that Soros is a super strategic trader, and it's pretty obvious why he's so successful. Just remember, Ichimoku, Elliott, price action, harmonic pattern, smart money, trend line, support and resistance, and all that stuff aren't really trading strategies on their own. They're more like tools in your toolbox. Technical analysis is the foundation for building a solid trading strategy. The real magic happens when you can clearly outline your entry conditions, take profit levels, and stop-loss points on paper. If you handed that paper to 10 different people and they all agreed on exactly when to enter the market and what their targets are, then congratulations, you've got yourself a trading strategy. Imagine you've jumped into a trade at this point in the market for whatever reason, and you've set your stop-loss here while considering these points as your price targets. When I say everything should be written down and clearly defined, I mean you should jot it down for yourself. 1. Close 50% of the trade at the first target and move the stop-loss to the entry point. 2. Close 30% of the trade at the second target and adjust the stop-loss to the first target. 3. Close the remaining 20% at the third target. This way, you've got a solid plan and can manage your trade confidently. You really need to take a deep dive into your trading strategy and put it under the microscope to figure out whether it's actually making you money or not. It's all about crunching those numbers and understanding how your approach stacks up. Only then will you start to feel confident about your strategy and your trading skills. When you can see the results in black and white, you'll feel that good vibe about what you're doing, making it all the more exciting to keep pushing forward and improving. In this market, there's no strategy that completely eliminates losses. If someone claims that, they're just trying to scam you. Remember, every strategy has both gains and losses, but what really matters is the overall outcome of your trades. Keep your head in the game. So, I hope by now you've grasped just how crucial it is to build a solid strategy and its impact on profitability. But here's the kicker, much of that strategy goes hand in hand with capital management. We're going to dive deep into that in upcoming videos, so make sure to stick around. Trust me, you won't want to miss it.